So let's get into some basic economics. And by the way, if I start sweating profusely, please don't mind. It's insanely hot in here in Australia in summer now, so don't mind that. But let's get into some basic definitions for economics. So a transaction is when a person exchanges money or credit for goods and services. Now we did talk a little bit about credit in the previous section, but there is a bit more nuance which we will dive into. So just wait on me for that. But that is essentially what a transaction is. Now we can define an economy as all of the transactions that take place in that area. That's literally it. Or to be more precise, the sum of all of the transactions that take place in a particular area. So if we're talking about the Australian economy, for example, that can be defined as the sum total of all the transactions that are taking place in Australia. Now let's talk about markets, right? So a market is all the transactions for a particular good or service. So we have the wheat market here, and this would be the sum total of all the transactions, all the buyers and sellers of wheat. The steel market would be all the transactions from all the buyers and sellers of steel. The stock market would be all the transactions from all the buyers and sellers of stocks. So I mentioned this word credit, right? And I kind of discussed it a little bit, and we described it as the solution for when people need something that someone else has, but they don't need what you have, and we kind of describe that as credit. The way we're going to describe credit now is a little bit different, but I would say the principle is still the same. So let's dive in. So before we move on to credit, I just want to make a note of something, and that is that spending drives the economy. And I think the first question you may ask is, why does that happen? And that's because if the economy is the sum total of all the transactions in a particular area, then more spending means more transactions. So spending increases the economy or causes economic growth. So just remember that. I'll probably put it up somewhere, but spending drives the economy. So just like we have buyers and sellers in the economy, we also have lenders and borrowers. Now lenders usually have excess money which they don't know what to do with, and borrowers need to buy something that they cannot afford at the moment. So the lender will give the borrower money, and the borrower will give the lender credit, and that credit just appears out of thin air. So in the previous example, when we were talking about the barter system, we kind of view this credit as a promise, right? It could be a promise for 10 sheep, promise for some logs in the future, something like that. So this kind of still holds because this credit is essentially a promise that the borrower is going to pay back the lender over some time span. Except like the kind of nuance is that this credit consists of kind of two parts, and that would be the principal and the interest payments. So the principal is the same amount as the money that was exchanged, but the interest is the extra payment that the lender receives because of the service of providing money. So that's like the incentive to lend money. So that is what credit is. Now, there is another term for credit which I'm pretty sure you're familiar with, and that is debt. So debt is the other word for credit, which makes it slightly confusing, but that's how it is. So debt is both an asset and a liability, and if you don't know what an asset or a liability is, I'll give you a simple definition. An asset is simply something that puts money in your pocket, and a liability is something that takes money out of your pocket. That's a simple definition, and it turns out that debt is a liability to the borrower, but an asset to the lender, because this debt will provide money to the lender, so it's an asset, and it will take money out of the borrower sometime in the future, so it's a liability. So we kind of talked about how credit is made of both the principal and the interest, where the principal is like the original amount that was exchanged, and the interest is kind of like the incentive, the add-on that you get. So interest is determined, the amount of interest you get, the lender gets when they when they lend out money, and the amount of interest that the borrower has to pay is determined by interest rates. And vaguely, interest rates are controlled by the central bank. So each country has a central bank. You have the Central Bank of USA, the Central Bank of Australia, Central Bank of Japan, etc. And the central bank vaguely controls the interest rates. Now, there isn't some kind of lever or magic button that they have which controls the interest rates, but they are a major influence in the interest rates. So the point I'm trying to make is that this interest is determined by the interest rates. So naturally, when interest rates are higher, you can expect less borrowing. Why? Because it's more expensive to borrow money. If interest rates are high, then the interest that a borrower has to pay on a loan is going to be a lot higher. So there'll be less incentive to borrow because it's a bit more expensive. And the other way is also true. The opposite is also true. So if interest rates are low, then interest is going to be lower. So there will be more borrowing because borrowing is cheap. It's easy to get more money. It's easy to buy things that you can't afford. So there's going to be more borrowing when there's less interest rates, or when interest rates are lower. So let's talk about the creditworthy borrower. So for a borrower to be creditworthy, that means that lenders are more likely to give this person loans because they trust that that borrower can repay their loans. And there are two aspects to a creditworthy borrower. The first aspect is collateral. So these are assets like a house or a car which the borrower owns, which the lender can take possession of if the borrower is not able to meet their payments. So a borrower having collateral makes them creditworthy. And the second thing is that their income should be greater than their debt. So if they have existing debt, their income should be greater than that debt, and that kind of proves that they can pay off their debts in the long term, and they will be able to pay off the current debt which they are applying for. And that makes them creditworthy. So two important things are assets and income. If the income is great and they have assets to back them up, then they are creditworthy and they will be more likely to get loans from lenders. Now, credit actually progresses the economy. And the reason for this is because spending progresses the economy. Remember we mentioned earlier that spending progresses the economy? Well, that's exactly why credit progresses the economy. So let's dive into that a bit. So here we have a little cycle here, right? So we have a person who's getting some income, and because of that income, they are able to borrow money. And because they have more money available, they're able to do more spending, which then hopefully increases their productivity, which then increases their income. So if income is going up, then borrowing will go up, spending will go up, and productivity should also increase. Now, the interesting thing about spending, right, is that one person's spending is another person's income. Just think about it, right? If you're spending money, someone else is earning that. And if you're earning money, someone else is spending money for you to earn that money. So one person's spending is another person's income. So this actually creates an interesting chain because your spending is someone else's income. So we can kind of continue this graph here. And that spending is someone else's income. Now the reason I go like a step above is because spending is increasing. We're seeing a progression because incomes are rising, borrowing is increasing, spending is increasing, and that increased spending becomes someone else's increased income, which then, completes the cycle on and on. So you can see that more spending results in more income for someone else, which then results in them being able to borrow more money, and therefore spend even more money, which is someone else's income. So they end up borrowing more money, spending more money, which is someone else's income. So the cycle keeps going. So you can see this upwards progression in the economy, right? So credit progresses the economy, and the only reason this happens is because spending progresses the economy. So increased borrowing increases spending as well. So I think it would help if we make this a little bit concrete. So I'm going to put some figures on here so we can kind of understand this a little bit better. So let's say this person is earning 100K. With that 100K income, they're able to borrow 10K, for example, so 10% of that. Therefore, they are able to spend 111K. Now this 111K in spending is someone else's income because one man's spending is on the person's income. So someone else is earning 111K. So they are able to borrow 11K, remember 10%. So they're able to, wait, is 11K 10% of, am I tweaking? No. Okay, so this is slightly off, but okay, just for example's sake. No, this is not even meant to be 111, this is meant to be 110. Dang, I'm tweaking. Okay, so this is 110. 110K, apologies there. So 110K, he's able to borrow 10% of that, which is 11K, and that increases his spending to 121K. And you can see it just keeps on going like that. Increased income results in increased borrowing results in increased spending, which then results in increased income for someone else. So credit progresses the economy. So far we've been talking about, the happy-go-lucky side of borrowing, right? Borrowing more helps you spend more, which increases your productivity, which, makes the economy grow. But let's talk about the other side of borrowing, which is when you actually have to pay off your debt. So borrowing now means you can spend more than you make, which literally makes sense because you have an income, you're going to borrow some money, so now you can spend more than you actually make as an income. But doing that sets yourself up in the future for a time when you have to spend less than you make to pay off your debts. So when you borrow, you get an increase in money, an increase in spending, so you can spend more than you make. But in the future, you'll have to spend less than you make to pay off the actual debt. Now, once you've paid it off, you can then borrow again, which increases your spending, increases your income, stuff like that. And then in the future time, you'll have to pay off that debt, which will then decrease your spending because you have to make those debt repayments. So something I forgot to mention, and something that's actually quite fundamental to this discussion, is the fact that money plus credit equals total spending. So money is like the dollar bills that are in circulation, the physical dollar bills that are in circulation, and the actual money that is available in the economy. And credit is all of the debt that is in the economy, which is still money, but is going to be paid off at a later date. But we still consider this as money. And the interesting thing is that in the US, and this, I'm just taking the example of the US because this is the example I heard. In the US, the money, or at the time of the research which I read, the amount of money in the US was $3 trillion, I think it was, and the amount of credit was like 97 trillion. I'm not too sure how accurate that is, but I remember reading that about 97% of the money in circulation in the US at that time was credit. So 97% of that was credit. And so by adding up the money and the credit, we get the total spending. And then if we take that total spending and divide it by the total quantity of goods that are being produced, we get the price, right? So spending of a quantity equals price. That's like a basic formula. So the interesting thing about this formula is if spending goes up, then price is also going to go up, right? So if the rate of spending outpaces the rate at which goods are being sold and created, then the price is going to go up. And this is where you get into your basic demand and supply, right? If there's more demand for a product, so spending is more, but the total quantity stays the same, then the price of that product is going to go up because there's more demand for it. If total spending goes down, so if the demand for something is very low, then the price of that is also going to go low because no one really wants it. There's no demand for it. So when total spending goes really, really high, like really, really high, then price is going to go really, really high. Price is going to skyrocket. And there's a term for this, and that's inflation. So the term for this is inflation. Inflation is simply when prices are going up. So borrowing is not inherently bad. Just because it sets you up for a time in the future that you have to pay off your debt, that doesn't mean it's bad. But there are positive use cases for borrowing, and there are negative use cases of borrowing. So a positive use case would be buying a brand new tractor. So if you're a farmer and you're taking out a loan to buy a brand new tractor, that tractor is going to help you grow more crops, which is going to increase your income, which is going to help you pay off your debt. So in the long run, the tractor is actually helping you create more income, it's helping you generate more income, which is going to help pay off your debt. So that's a form of positive borrowing. Now, a form of negative borrowing would be buying a brand new TV. So this doesn't increase your income in any way. Watching this TV doesn't help you increase your income in any way. And therefore, it doesn't help you pay off your debt. So it's negative borrowing. It doesn't really help you in any way. So borrowing itself is not bad. Taking out credit to start a business is not bad. But it should help you generate more income in the future so you can help pay off your debt and actually grow your little economy as an individual. Okay, so now we're going to tie everything together. And the way we're going to do this is with something called the short-term debt cycle. And this is really interesting because this is like, when I first learned about this, it was like really insightful to learn how all these pieces actually play together, and it actually makes sense. So let's actually get into it. So the first part of this cycle is more income. So people's incomes are rising, people are more productive, people are generating more wealth, and that increased income means that they can borrow more money, and that increases their spending. Now, we noted before that spending drives the economy, and we can see that here where total spending, we had this formula which we discussed earlier, which is total spending or total quantity equals price. So an increase in spending from everyone, so there are more transactions in the economy of higher value, so the economy is going up. So more spending actually results in higher prices because more spending drives prices up, causing inflation. So this is when spending becomes so high, that prices become so high that more spending actually causes inflation. Now, the central bank doesn't want too much inflation. It doesn't want inflation to be too high because it causes problems, right? So what it's going to do is it's going to raise interest prices. So because it's raised interest prices, borrowing is now more expensive. So higher interest rates make it more expensive to borrow. So borrowing decreases. People are not borrowing money as much because it's expensive. And that also decreases spending because people have to pay off their debts, right? We noted earlier that when you borrow money, you spend more than you make, and then in the future, you'll have to spend less than you make. So spending decreases. So once debts have been paid off and the economy restores itself, the central bank can then lower interest rates again. And then lower interest rates lead to more borrowing, lead to more spending, and then price increases, inflation. Central bank controls that using the interest rates. People pay off their debts. Then the central bank lowers the interest rate, so it's more cheap to borrow money. It goes again, it goes through the whole cycle. So this is really cool stuff. And that's the short-term debt cycle. So that's kind of bringing together a lot of the concepts we discussed in this video. This is going to be the first part in, I think I'll make it a two-part series. So we'll end with the short-term debt cycle, and in the next video we'll be discussing the long-term debt cycle and a little bit more into economics and finance. But I hope you enjoyed this video. I definitely enjoyed making it and researching, all these different concepts. But yeah, it's been fun. Hopefully you learned something, and hopefully me in 5 years, you know a lot more about economics and stuff, and you're looking at the stuff and saying, oh, it's child's play. But yeah, okay, thank you for watching the video, and I will catch you in the next one. Peace.